Hello, in this video I am going to cover consumer leverage ratio. Sounds fancy, not too fancy. So the consumer leverage ratio is basically used to quantify the amount of debt the average consumer, a lot of the times the average American consumer has relative to their income, not their total income, but their disposable income. And generally speaking, the higher the number, the worse it is. The lower the number, the better. So let me write out the formula, and then I'm going to explain it again in a slightly different way. So it is the consumer leverage ratio is equal to the total household debt divided by the disposable personal income. So another way to think of it is it tells you how long a individual would take to pay off all the household debt. So that factors in a couple of things. One, assuming the household debt does not increase. Two, it also is assuming that you are spending all your disposable personal income on this, and it is not factoring in any increases in disposable personal income, maybe due to the way you're saving, or maybe you're earning more money, or maybe you potentially have less disposable income, maybe in 6 months or a year's time. So it's not factoring any of those things in at all. It's not factoring in inflation, it's not factoring in interest. So there's a lot of things it's not factoring in, but it's just a good quick metric to use. And what I don't like is that this is all green and that's green as well. A different color for this, so I'm going to put consumer leverage ratio. So let's get an example. Let's get an example. So imagine, scroll down. Imagine if I'm going to call this CLR, just so it's CLR, and this equals, and let's say somebody, the total household debt, and let's just say the only debt the household has is a mortgage, and it is £250,000. The actual currency is irrelevant in this scenario, it doesn't really matter. So let's say that's all they have. They have no other consumer debt, but if they do, you just add it all together. And let's say the disposable personal income for that individual, let's say lives on his own as well. Let's call this guy. Let's call him Johnny Boy. And his disposable personal income. So let's back up a moment. Let's say he earns £50,000. Let's say after tax, minus tax, he has left £40,000. And then let's say he has necessary expenses, which are £10,000. Now I'm gonna say 20 just to make the numbers easier. So £20,000, and so he is left with £20,000. So he's left with £20,000. So you do 250,000 divided by 20, which gets you 12.5. So drum roll, the CLR. So drum roll, the CLR is 12.5. Don't like the way that 5 was done. Let's do that. 12.5. I also want to confirm the calculation is correct. 10 times by 20,000 is 200,000. A quarter 2.5 times by 20,000 is 40, 50, 250,000. That is correct. So that means 12.5 years it would take Johnny Boy in this scenario to pay off all his household debt, assuming he spent all of the disposable personal income paying it down. Also assumes he doesn't get any salary increases, any salary reductions, he doesn't improve his savings or his expenses, or that doesn't go worse, he doesn't have any other necessary liabilities or anything like that. So that's the consumer leverage ratio. You can apply it to, you could sort of adapt it to just one type of consumer debt. Maybe like in this scenario I was talking about the mortgage being his only expense, but you could apply it just to mortgage or just to student loan or to loan on a TV or some furniture, for example. So that's the consumer leverage ratio. If you have any questions, feel free to pop me a message on the Discord group. You can post in one of the finance channels, and as usual, I look forward to seeing you in the next video.